What's going on, everybody? Jeff here. Welcome back to the channel. All right, I've got some interesting data I really want to share with you guys. I'm going to break everything down from A to Z. I've been banging my hand on the table, making numerous videos talking about two things. One, stop listening to the Federal Reserve, the government, and what the mainstream media is telling you that is happening inside the economy, and start to look at some of your top leaders, okay, as well as some of your large companies. In a recent video, I said you are seeing polarizing perspectives from the mainstream media and what actual large companies are telling you. Microsoft with layoffs, Google, Tesla, okay, Meta, and there was a Ford even said that. And there's been multiple ones already talking about layoffs. This precedes a recession. This precedes an economic collapse. I want to talk now about the real estate market. As some of you know, okay, the real estate market is very close to me. I am a pretty heavy investor, not only in stocks, but in real estate as well. I've been waiting for my opportunity, and I've seen numerous of my mentors and people that I look up to that have massive portfolios, have 8 to 9 figures assets under management, people that understand this information better than I could. And what we're seeing is getting to be alarming. And the reason why I want to share this with you is because I look now where I'm at in 2022, and I think to myself, if I were to know what I know now going through 08, 09, even to 2010, and be able to position myself to ride the entire wave to the upside, it would be amazing. And the only thing that you can do now is to obviously predict to what potentially could happen by looking at the data, because clearly nobody knows. You're right, you might think you know, but nobody knows until it exactly happens. But mainly prepare. So I want to talk about everything for you guys. Let's get right into it. First off, mortgage applications come out weekly. Okay, it's 7 a.m. Eastern time on Thursday. We start to see some of the way this data is coming in. I think it's a little bit lacking, and this number does not explain the magnitude of what is happening. So it came through at minus 6.3%, which means mortgage applications are down. You can clearly see by looking at this chart since October of 2021, seeing at that 800, 700 level to where we are 50% lower by looking at a bigger perspective, not just looking at this smaller number. Okay. Now, when you take a look at something even closer, the refinance year over year change is down 80%. Now, let me bring this back to you. I run a marketing company specifically tailored to loan officers. I'm quite removed from the company. It really runs on its own. There's an entire sales team, okay, that keeps that wheel running. But when COVID had hit, a lot of my business completely halted. Okay, loan officers who had already been through 2008 were like, wait a minute, we need to stop all of our spending. We don't know what's going to happen. Then things quickly changed. Okay, when quantitative easing went into full effect, the refinance business boomed. Okay, a huge percentage of their income, loan officers' income, was from refinance. Okay, and as you can see, they're down 80%. Now, going back and take a look at this chart I have for you guys, looking at interest rates over the last 30, 40 years, okay? Right now we're sitting at about 6%, which means if you purchased a home anytime after 2009, you got a lower rate than what rates are at right now, okay? And if you purchased a home, and that's or refi, which means if you purchased back in 99 and you had that 8% and it came down, yes, okay, you can refinance now at 6%, but think about all this time. You had 10 years to refinance at a much lower rate, meaning the chance of people refinancing right now are slim to none. I own multiple properties. I have loan officers calling me, not only from my current mortgage companies, that holds my loans, okay, talking about refinancing. Listen, Jeff, you only owe 100 grand. The house is worth 300 grand. You could, we could borrow at 75% loan to value. You can go buy another house right now. I said, well, what are your interest rates at? It's a little bit different because these are investment properties, but it's still much higher than what I have. I have anywhere between 4.75% and 5.25%, which, like I said, investment properties are a little bit higher, especially for where I am and so forth. But now those rates are much higher. Point of the matter is, I'm not touching it, okay? I'm not touching it. So you got to think the only people that are going to be refinancing right now are people that need cash. The only time people need cash is when they're in struggles, okay? This leads into layoffs. This comes into less disposable income. This comes into an entire whipping effect, okay, of what happens and how the real estate market is a huge central factor into this. Also, take a look at when you think about where interest rates could potentially go. When was the last time we saw hyperinflation? When was the last time we saw inflation getting out of control like it is right now? When is the only time frame that you hear people talk about to where we can compare to? We talk about real estate crashes. We look at '08, okay? We talk about market crashes. We look at '08 and we look at 2000. We talk about rampant inflation and hyperinflation. We look at the '70s. So if you're thinking where potentially interest rates could go, here is what you can look at for data. Here's what you can look at for history, okay? 10%, 14%, 18%. I've said this numerous times before. I'm gonna say it again. My father bought his first home in 1982. His interest rate was 14%. Okay, so seeing it we're at 6% is much higher than we've seen in the last 10 years. It's absolutely, it can still go much, much higher. Okay, now on the contrary, when we talk about the real estate market, okay, look at this. Mortgage demand falls to lowest level in 22 years, which means everything that we went through in '08, the demand is less than what it was. Okay, lastly, I have one other thing. The entire value of the real estate market. Now, I look at the real estate market and how it relates to GDP. Okay, it's 15 to 18% of GDP, which means the real estate market, okay, is the number one asset to our economy and how it moves. Okay, when you see it's grown by 6.9 trillion to 43.4 trillion, and this is directly from Zillow. There is a couple different numbers out there, but this one is from Zillow, more than double the level from a decade ago as the market fully recovered. There's two things I'm looking at right now. One, the downside is still there. Two, what happens when we talk about companies laying off? What happens when people have less disposable income because their crypto is not pumping, okay? Because they're not able to make money as easily in the stock market, or if you just are a long-term buy and hold, you had Apple at 100, it went all the way up to 180, it got down to 130, now it's at 150. Let's say it goes back down. You look at your 401ks. If the baby boomers make a huge percentage of the group of people that spend money in the economy, and you're looking at your 401ks, they don't have that disposable income. A lot of them are going to be retiring soon or are already retired. They don't have the ability to continue to make that cash. They look at that huge lump sum and they say, oh, it's down from 1 million to 650,000, getting a little bit nervous, going to start spending less. What happens when people start spending less? Companies' revenues go down. What happens when companies' revenues go down? Next, their profits are lower. What happens when profits go lower? They start to lay off. What happens when they start to lay off? We've been talking about this layoff for numerous times. That's when the trouble happens. That's when credit cards start getting maxed out. That's when they stop getting behind on payments, such as car payments, mortgages, and the whole thing just landslides down. So my point behind all of this and behind some of this data, I wanted to look at for a year-over-year basis, okay, and really piggyback off of the video I made last week talking about how these big companies are starting to lay off. It is a huge red flag. You look at people like Elon Musk, okay? First of all, he's brilliant. No matter what your opinion about him, he is brilliant, and he has access to more people than probably anybody can for the information. All right. You also look at real estate moguls that are running advertisements, not only for their own companies, but banging their hands on the table the same way, saying, listen, now is the time to prepare. Okay. So, like I said, I'm going to continue to make videos on this. My whole point behind all this is you're going to have some time. This is not going to happen overnight. Okay, and really formulating a plan to be able to prepare over the next 6, 12, 18, 24 months to be able to set yourself up to ride the next wave, because recessions are a part of an economic cycle. Crashes are a part of an economic cycle. Okay, we talk about bear markets versus bull markets when it comes directly to the stock market. Bear markets, they're normal. They last much, much shorter. All right, so guys, that's it for this video. I'll see you in the next one.